take your seats. We are starting with the next session. We will have two presentations, and the first will be by Randall Quarles, who's the chair of the Financial Stability Board, and of course the vice chair of the Federal Reserve. And he'll talk about the work by the FSB to promote common understanding and harmonized disclosure, common understanding on data, harmonized disclosure, to help actors in the financial markets to measure climate risk and manage them. And the second presentation by Mark Carney will focus on what private financial institutions are doing, what they could do in the future to mobilize the resources needed for the net zero transition. Mark Carney, as I think everybody in the room knows, had a long career both in the private and public sector. And although there are many experienced central bankers here and that have been in Venice, I think he has the rare distinction of having been the governor of two separate national central banks, besides, of course, being Randy's predecessors at the FSB and Mario Draghi's successor at the FSB. But now he is speaking, I think, in his capacity of as the UN Special Envoy for Climate Action and Finance, and the UK's Prime Minister Finance Advisor for COP26. So Randy, you can take the floor first, and then Mark will follow with his remarks. Please go.
Terrific. Thank you. Thanks, Federico. It's a pleasure to be here. After a year of remote conversations, it really is wonderful to see you all in person. As chair of the Financial Stability Board, I have the privilege of collaborating with the Italian G20 presidency, with the G20 finance ministers and central bank governors, and with the FSB membership on the most pressing issues affecting financial stability. And among those issues, one of increasing focus is understanding and monitoring climate-related financial risks. And given the global nature of climate change, this demands a coordinated international effort. So the FSB published last Wednesday a climate roadmap that presents a comprehensive and coordinated plan to address climate-related financial risks. The FSB's roadmap dovetails with the ongoing work of the G20's Sustainable Finance Working Group, or SFWG, to develop a broader sustainable finance roadmap. So today, in my role as chair of the FSB, I'd like to focus on two foundational components of the FSB's roadmap: disclosures and data. Globally consistent, comparable, and reliable disclosures, as well as a broader set of high-quality relevant data together, can provide the basis to assess climate-related financial risks and the impact on financial stability. The FSB was an early leader in bringing attention to the importance of reliable entity-level disclosures to assess and manage climate-related financial risks and opportunities. In 2015, under Mark Carney's leadership, the FSB submitted a proposal to the G20 to create an industry-led disclosure task force on climate-related risks. The work of this FSB-sponsored Task Force on Climate-Related Financial Disclosures, or TCFD, has led to greater recognition of the importance of climate-related financial risk and of comparable and reliable disclosures. The early development of industry-led recommendations and a usable framework by users and producers of this information was critical. And the four core elements of TCFD recommendations have provided a widely accepted framework for disclosures, covering governance, strategy, risk management, and metrics and targets. The task force has continued to provide significant support to those seeking to disclose and has encouraged steadily increasing uptake. These initial steps greatly help to define appropriate parameters, drive towards consistency, and give the public sector a running start in developing their own approaches. Now is the time to build on that work. It will be useful to establish a globally consistent baseline standard for climate-related disclosures. Globally consistent and comparable entity-level disclosures by non-financial companies, by banks, by insurers, and by asset managers are increasingly important to market participants and financial authorities as a means of providing information needed to assess and manage risks. The G20 presidency, in developing its 2021 work program, asked the FSB to encourage more consistency in disclosure practices. As a start, the FSB surveyed what financial authorities across our membership were doing to promote disclosures. Almost all of our members have already set requirements, guidance, or expectations, or plan to do so. We found some heterogeneity in the approaches they were taking. Some members prefer mandated disclosure, others would make it voluntary. There's variation in the desired scope of disclosures, but there is a trend towards an important baseline that focuses on one-way materiality, that is, the financial risk that climate change could have on a particular entity, based on the TCFD recommendations. The majority of our membership are already using the TCFD recommendations as a baseline for their own requirements or guidance. The International Financial Reporting Standards Foundation, or IFRS, in consultation with other international organizations, will develop now a set of standards, starting initially with climate, and building upon these TCFD recommendations. As reflected in our statement of December 2020, the FSB supports IFRS's advancement of an International Sustainability Standards Board to take this work quickly forward. This work holds the promise of providing baseline standards that could inform or be built upon by national authorities as they develop their approaches to climate-related financial disclosure or to broader sustainability disclosure. The initial focus of the IFRS will be on climate standards, while allowing for interoperability with individual jurisdictions' frameworks that may go beyond climate-related impacts. But consistency in one-way disclosures would provide a needed avenue for accurate and appropriate risk assessment and comparability to assess investment decisions. Simultaneously, the IFRS standards are intended to provide flexibility for national authorities to build on the baseline. The interoperability feature will allow jurisdictions to address broader or jurisdiction-specific concerns in a manner consistent with their legal and regulatory frameworks, and indeed to go further in scope or faster if they wish. Given the importance of this work, we encourage the IFRS to press forward as quickly as possible. In the interim, the FSB encourages jurisdictions that are implementing frameworks to base them on the TCFD recommendations to avoid unnecessary fragmentation. The need for high-quality, reliable data doesn't stop at firms' disclosures, however. International initiatives are needed to improve data quality and to address data gaps, and ultimately to establish a basis of comprehensive, consistent, and comparable data for global monitoring and for assessing climate-related financial risks. We published a separate report on this topic last week. Our data needs include data on the underlying drivers of physical and transition risk, and on financial institutions' exposures. The challenges here are considerable. To understand the financial risks, better information is needed on the underlying physical risks, including the sorts of extreme weather events that pose greatest risks to the balance sheets of households, firms, and financial institutions. Comparable data is also needed on the nature of jurisdictions' climate change targets and on their progress in meeting them. All this information needs to be related to financial risks, including financial institutions' exposures to non-financial counterparties. As has been said earlier today, this is not an easy task. The current lack of usable data is a reflection of difficulties in transforming existing information on the drivers of climate risk into reliable metrics that quantify financial risks. The key here is to find metrics that are forward-looking, recognizing that the nature and magnitude of future climate-related risks may differ from those in the past. Improved financial risk data can also help achieve the financial stability mandates of financial authorities. For example, the FSB is exploring how to assess the degree to which climate-related risks might be transferred or amplified by different financial sectors. For example, the interdependence of banks and insurance firms. Climate-related risks vary across jurisdictions. We need to look at how risks might be amplified by feedback loops with the real economy. Such analysis will contribute to a more comprehensive and global understanding of how to assess climate change and potential effects on the financial system, but those efforts are hampered by a variety of data limitations. The FSB is working with international bodies, such as the International Monetary Fund, other international groupings, such as the Network for Greening the Financial System, to assess climate data gaps and to identify steps to address them, with a special emphasis on ensuring cross-sectoral and international consistency. For example, the FSB plans to coordinate work with the NGFS on the issues surrounding scenario analyses, which some jurisdictions are using or contemplating, and the financial metrics that would be useful for such an analysis, both at the level of the firm and the overall system. Examining scenario analysis presents many challenges: a very long time horizon, which requires dynamic balance sheet analysis, and the need to capture the interplay between the macroeconomy and the drivers of climate-related risks are two such challenges that need to be overcome. So today, the FSB is well positioned to lead the next phases of the work required to address and assess climate-related financial risk. The FSB's mandate, its diverse membership, and its connection to the G20 make it the ideal forum to forge a consensus on the appropriate path forward. The FSB, as laid out in our roadmap, has taken on a critical role in coordinating and carrying forward work that will make the global financial system more resilient to the threats posed by climate change. The roadmap establishes a strategic vision for addressing climate-related financial risks, which sets out how we'll coordinate with other standard-setting bodies and international organizations in order to make progress towards our goal. The climate roadmap leverages the FSB's strength as a coordinating body, provides some structure to the vast amount of work on climate-related financial risks that's currently going on internationally, and clarifies interdependencies between various work streams and between issues. The climate roadmap sets the course and promotes consistency through, among other things, building consensus around common principles, best practices, and cross-jurisdictional alignment. These include the two broad objectives I've focused on today: establishing consistent, comparable, and reliable information through a global baseline standard for disclosures, and through improving the availability and quality of data. The roadmap also includes work on analytical tools and on policy approaches developed for identifying and managing climate-related financial risks. We have a long road ahead of us, but every journey begins with the first steps, and the FSB will continue to coordinate and contribute to understanding and addressing the challenges to the financial system that arise from these risks. Thank you.
Thank you very much, Randy. It's very impressive, and I'm going to touch on the FSB roadmap. I'll just underscore at the start how important and significant it is. I would like to thank you, Governor Visco and Minister Franco, for bringing us to Venice, for the inspiration and the progress, but fundamentally for the Italian presidency's drive to build a more sustainable global financial system, a drive that extends to your leadership in COP26 alongside the UK. I went back, like many, I went back to the history of Venice, refreshed on the history of Venice, and I realized that the first inhabitants here were seeking shelter in the marshlands from waves of invasions, invading hordes, if you will, as the Roman Empire was going through a little difficult period. But from those humble beginnings, obviously they built the foundations of a great commercial power that would conquer the world through trade. The analogy is that Venice, indeed the whole world, is again under siege from rising sea levels, from extreme weather, from climate change. And these waves won't stop unless we build the right foundations and then look outwards to transform our world. And that's what the Italian presidency is doing through the G20, helping to lay the foundations of a financial system in which every decision takes climate change into account. And Randy has just stressed the core elements of that. I want to hit those quickly and then look outward, and reinforce just the importance of climate financial reporting, because what's measured gets managed. It was only 5.5 years ago that TCFD was a concept at Paris. Just 3 years ago, the recommendations were delivered to G20 leaders in Hamburg. Today, virtually the entire private financial sector wants this disclosure. Over 2,000 major companies across the G20 are responding. But as you've heard, despite these advances, coverage is still limited, and disclosure itself, or reporting itself, is incomplete, particularly of those critical forward-looking metrics. The private sector has taken this about as far as it can, and now is the time for the G20 to finish the job and make TCFD disclosure mandatory. Very much welcome the FSB's roadmap that was released last Wednesday, and the support of the G20 for it, the importance of disclosure at its heart, and also very much welcome and salute you, Erkki Leikinen, for the IFRS's foundation's intention to establish a new international sustainability standards board to produce a climate disclosure standard based on the TCFD by the middle of next year. I think this is something I'd underscore, and clearly building on the progress that's been made elsewhere. Now, better disclosure, it's not perfect, and we do need better disclosure and more data, but that and a heightened sense of urgency is leading to a transformation in climate risk management. This began with central banks and supervisors at the NGFS just a few years ago. There were 8 founding members. There are now over 90 authorities in countries representing 80% of global emissions and all of the world's globally systemic financial institutions. Central banks in countries with more than 50% of global emissions are beginning to conduct climate stress tests. And I would like to salute the BIS, the NGFS, the IAIS, and the Sustainable Insurance Forum, who have banded together and today are launching the Climate Training Alliance, which is a way of building financial risk capacity more broadly. Now, for COP26, our priorities with respect to the foundations of the system are to secure mandatory disclosure, climate disclosure, to embed supervisory expectations for more effective climate risk management, to mainstream the use of those NGFS scenarios, not just for stress tests, but more broadly their use within the financial sector so they can be used and improved, and to ramp up climate stress testing. So those are the foundations, and now I want to look outward and focus on 3 elements: commitments, alignment, and engagement. Commitments obviously begin with the net zero commitments of countries. These have risen from 30%, covering 30% of global emissions when Italy and the UK assumed the presidency of COP. It's now over 70%. And those country-level commitments are cascading down to the levels of companies, company net zero commitments, and we are building commitment within the financial sector for a whole economy transition, because I think, as this room fully appreciates, we will not get to net zero in a niche. Rather, it's virtually every company in every sector that needs to transform, as Linda Ealing was saying in the previous session, and this will require enormous investment, up to $100 trillion over the next 3 decades. Now, you've heard a bit about the Glasgow Financial Alliance for Net Zero, or GFANZ. It was created to help meet those needs. It currently brings together over 250 financial institutions responsible for well over $80 trillion of assets. It's anchored in the COP's Race to Zero. It's the gold standard for financial sector commitments to sustainability. By joining GFANZ, financial institutions commit to manage their investments or their lending or insurance underwriting as appropriate to net zero by 2050. But they also set interim targets across Scope 1, 2, and 3 emissions, including 5-year decarbonization plans and sectoral targets. They embed board accountability, and they will report their progress annually. We will deepen and broaden GFANZ membership in the run-up to COP. We've added over $10 trillion in assets in just 2 months since it was launched at the Biden summit. Major insurers and reinsurers are working on an alliance to align their underwriting with net zero, as you'll hear more from Generali's CEO Philippe Donnet shortly, I think in the next panel. And also, as you've heard from Linda Ealing, we're forming an alliance of market infrastructure providers, including index providers, credit rating agencies, stock exchanges, who will align their products. This is the critical thing. They're aligning their products and services with the financing of net zero. By Glasgow, in November, all major financial firms, including private equity firms and sovereign wealth funds, should decide whether they too will be part of the solution to climate change or risk facilitating the type of climate arbitrage to which Larry Fink referred in the earlier panel. I'm also pleased that Larry is joining Jane Fraser of Citi and Oliver Bott of Allianz in leading another GFANZ working group which is looking to address net zero transition plans, including issues around how to defease stranded assets. So GFANZ, it's a big tent. It's also the only tent that will be available at Glasgow. There are many well-intentioned initiatives, but now, as we've learned over the course of today, or been reminded, I think this group been reminded over the course of today, now is not the time for half measures. So GFANZ starts with commitments, but its real purpose is climate action through alignment and engagement. Alignment means defining best practices for net zero plans for companies and financial institutions. And to these ends, it will leverage existing work on net zero plans by member alliances and initiatives such as PCAF, or the Partnership for Carbon Accounting Framework. It will build on existing sector and country-specific science-based pathways from organizations like the Transition Pathway Initiative and Science-Based Target Initiative. Alignment also means robust assessments of the portfolios of financial institutions relative to net zero pathways. GFANZ members, as I said a moment ago, are focused on whole economy transition. It requires much more than the financing of deep green activities or blacklisting of dark brown ones. We need 50 shades of green to catalyze and support all companies that are committed to moving to net zero. And in this regard, I'd like to commend the central banks, notably the ECB and the Bank of England, who are helping to set the tone and develop some of the technologies in order to do this as they look at revising, as appropriate, their collateral frameworks or monetary policy operations consistent with their legislated responsibilities in their jurisdictions. Now, more broadly, the options range from setting targets for emissions to eligibility assessments that are based on whether companies have net zero transition plans, to tilting portfolios to issuers that perform strongly on climate change metrics based on scorecards of past efforts to decarbonize, current emissions intensity, and forward-looking metrics. And in the private sector, there is work that has been done, again, coordinated through the TCFD, that has looked at, has conducted an extensive review of methodologies to assess portfolio alignment techniques, including benchmark, divergence, and implied temperature rise assessments that Linda Ealing referred to earlier. And what's happening is we're now picking up that work into GFANZ to see how it can be applied more broadly across the financial sector. And this will provide an essential complement to more binary taxonomies that serve more specific objectives. Now, the combination of forward-looking climate disclosure, net zero plans, and portfolio alignment will pull forward investments, especially if there are credible and predictable climate policies. So I'm hearkening back to this morning's discussion and the discussion chaired by Gillian. And one of the things she referenced, a paper that Janet Yellen, Philip Hildebrand, and myself participated in for the G30, which made this point, and actually Augustine, who's not here at the moment, that's the analog to central banking. That is, if you have the predictable policies and you have a financial sector that has the information it needs, it will pull forward adjustment. As I would suggest, as a practical example, we're beginning to see in the European automotive sector because of the decisions that Paolo Gentiloni and others have referenced. Okay, this brings me to my final area, which is around engagement. Now, estimates vary, but most suggest that the world will need at least an additional $1.5 to $2 trillion of investment annually for up to 3 decades as we transform our economies. The IEA estimates that 3/4 of this must flow to emerging and developing economies, and about 3/4 of those flows would be privately financed. I think it's safe to say that wherever you fall in that range, we're well off the mark. In recent years, and Shamara referenced this, it's about a 20-to-1 ratio on their numbers in terms of clean energy investment advanced versus emerging economies, and about a 6-to-1 ratio for sustainable debt issuance. So as others have noted, we need to do a few things. First is to turn billions of public capital into trillions of private capital by scaling blended finance as appropriate, catalyzing standalone private capital flows, and building new markets. MDBs, as others have mentioned, are uniquely placed to help with this, to mobilize private finance. I think we should recognize that, as I said a moment ago, that thus far the scale of what we've done, collectively done, is relatively modest. The official figures, which we'll understate, but the official figures suggest in 2018 that private finance in developing economies mobilized by MDBs reached $10.8 billion in 2018, or 14% of total climate finance. So orders of magnitude need to change. We have needs that are measured in the trillions, flows that are measured in the tens of billions at best. And I would suggest that a rule of thumb for climate finance is to concentrate on initiatives that have the prospect of catalyzing at least 50, ideally $100 billion of flows per year of investment flows to emerging and developing economies for decades. Of course, actual investments will depend on specific projects and the overall investment environment within recipient countries, including the credibility of NDCs. But those conditions are more likely to develop if sufficient financing capacity is in place, or at least the prospect is in place. And I'd suggest that in order to help orchestrate a step change in that financing capacity, there are 3 related initiatives. The first comes from the private sector. GFAN's working group, led by Shamara, will build on initiatives, including Fast Infra, the GISD, the CFLI, to secure commitments of significant private financing capacity for projects to advance the net zero transitions in emerging and developing economies. And that financing obviously will be both bank and market-based. Secondly, public facilities. The MDBs should be encouraged to identify and be prepared to dramatically scale up blended financial vehicles and facilities that support significant mobilization of private capital. There are some very strong potential candidates, including the IFC's Managed Co-Lending Portfolio Program, the African Development Bank's Room to Run Synthetic Securitization Program, and platforms like the G20's Global Infrastructure Facility. Thirdly, and crucially, country platforms, and we heard a bit about this earlier. The public and private sector are coming together through initiatives such as the GISD and the CFLI to build country platforms which will help address specific needs, such as phasing out coal in some countries or decarbonizing steel and cement in others, as well as broader investment environment challenges such as dispute resolution mechanisms and subsidies. Now, basic point is that we have the core of the private financial system, 80 trillion plus of balance sheet, that is focused on transition to net zero. So what follows from that is that country platforms need to integrate Paris-aligned NDCs in order to attract that capital at scale. It needs to be consistent with the alignment, but if it is consistent with the alignment, it will be that much more attractive. Projects that are consistent with long-term country strategies that are Paris-aligned are more likely to attract private capital and less likely to be subject, I would suggest, to project risk, including chances of changes in regulation because of the interrelationships there. Now, so as some others have suggested, we need a pretty radical adjustment to our international financing architecture for climate, and I again commend the Italian presidency for putting this on the table. I'm going to finish by referencing one element of that, which is the need to build a high-integrity market for carbon offsets. Now, the conditions for this market are coming into place. There are over 1,600 major companies that have committed to set science-based targets, not just net zero plans, but science-based targets. To achieve them, they need the appropriate mix. In fact, they need to focus first and foremost on absolute emission reductions. But there will be, in some cases, a need to use highly credible, high-integrity carbon offsets because of technological constraints, for example, in the steel and cement sectors. I'd go further. I'd suggest that, and I join Lord Stern and Lord Turner and others in this, I would suggest that to keep the total stock of our carbon emissions below our critical threshold, our aspiration should be that companies not only aim to meet net zero in 2050 as an endpoint, but on top of the absolute decarbonization of their own operations, in line with scientific consensus, companies should also compensate and neutralize residual emissions on the path to net zero. Now, in terms of scale of that market, at present, the market for carbon offsets, it's fragmented. There are a number of challenges with it, inconsistent. It's about $1 billion a year of investment. This market should be 100 to 150 billion a year, and can be that by the middle of this decade. And the capital flows are from companies in advanced economies for projects that would be overwhelmingly located in emerging and developing economies, potentially with significant co-benefits for biodiversity, SDGs, and in some cases, the funding of the avoidance of emissions and effectively the funding of defeasance of stranded assets. If you're interested, the private sector task force led by Bill Winters and Annette Nazareth have just completed their work. Over 250 organizations from around the world, a combination of private sector and NGOs, have published their final recommendations for this market. London and Singapore have signaled their interest in hosting this market, and I would strongly recommend, given the need for engagement on this. So let me finish. From those troubled beginnings that I referenced at the start, Venice, clearly a city of unimaginable wealth and beauty. Its splendor continues to inspire. Let's build on the inspiration of the last few days, build the foundations that Randy and his colleagues are putting in place for a sustainable financial system, align the flows for the capital investment that we need to advance our objectives for people, planet, and prosperity. Thank you very much.